Welcome back to Conversations with Kyle. Kyle is a CPA. And last week we talked about mistakes that you make on your tax returns and what happens. We got some questions about people worried about getting audited, and we did some quick Google searches and found some couple key topics that we're going to talk through today. So what should people know about getting audited, Kyle? Let's start with that.
Yeah, great question. Always a topic that people are asking me because it can be scary, right? It's IRS has teeth to it. If they want their money, you have to be very convincing, or have good backup for to support the numbers that you put on your tax return. And the IRS has always kind of done the what's called the quote unquote barbell approach, and where the top end gets audited frequently. The very low end gets actually audited pretty frequently in terms of claiming credits or refundable tax credits that they may not be entitled to. In the middle, it's less likely, but obviously still not impossible. And I've had, the last 10 years, 12 years, the audit rates have been going down so significantly. It used to be like 1 in 12 taxpayers would get audited annually. Now it's less than 1 in 100. So just as the IRS gets stretched on resources, and you read about all the backlogs and how backed up they are with all their work, they have been auditing less people, which I think has changed a lot of people's attitudes towards getting audited. And so I'm still here to remind you that it still happens, still something to be afraid of. And I think those are only going to go up here in the next 10 years as hopefully they get more funding and more resources to make sure everyone's doing everything correctly.
Yeah, and it seems like with COVID, there's like somewhere I read almost 2.5 million pieces of mail that has yet to be opened at the IRS.
It's a mess. Yeah, it's awful.
Yeah,
I can't get a hold of them anymore. It's just really, really hard. Used to be able to call the IRS, and within 15, 20 minutes, someone would pick up the phone. I was on the phone on Friday for 45 minutes, and then they just hung up on me for no reason. So
we've all been there. We've all been there. So
it's a mess.
So let's start with what are a couple of the easy things that would cause red flags? I think the first thing is if you're a business owner, right? Or if you have a Schedule C.
Yeah. So anything where you have more discretion, right? And, something that, like I said, you have flexibility in the numbers, and it's maybe an area where the IRS can crack down. And so business owners are obviously going to get audited more frequently, just in terms of claiming deductions. And in my experience, it's really the deductions that they audit more so than not, since revenue is usually pretty straightforward. Unless you're lying on your return, that's cash in is pretty easy to trace. But it's really if you're taking excessive deductions as a business owner, that's where my clients have been audited in the past. So.
What about crypto? I think crypto is another hot topic, right? We're in the new frontier of how that's really coming through.
Yeah, it's really been in lingo, I think, really since 2014, 2015, when I kind of first started seeing crypto transactions. And so now there's a question on the first page of your tax return: is did you buy, sell, or trade or otherwise profit from cryptocurrency? I don't think that's the exact wording, but it's something to that effect.
Yeah.
And now they're actually starting to kind of have policy on it, right? So they're actually starting to audit people. You have to come up with, you have to substantiate your basis numbers, which can be very difficult. I think, if you're depending on what you're doing within crypto, it can get really complicated very quickly. And the IRS is definitely targeting folks with lots of crypto transactions.
Yeah. I guess crypto transactions, like you mentioned on the 1040, but the whole blockchain should make it easier to track your process through crypto. So I don't know. Let's see how that goes. What about foreign transactions?
Yeah, so that's another area. Anything with the word foreign attached to it has historically been scrutinized by the IRS. And so the way they target foreign transactions is that there's really stiff penalties if you're not reporting anything with the word foreign attached to it. So that can be foreign bank accounts, foreign assets. If you're above the reporting thresholds, you should be including those on your tax return every year. And most of those are informational forms, but foreign currency transactions, that's where you're actually reporting income and loss numbers on your return that actually affect your bottom line. So that'll definitely be an area the IRS will focus on if that's an aspect on your taxes.
Sure. And I think a lot of people that have real estate or rental real estate, the difference of calling yourself a passive investor versus active. I think there's a threshold of, is it 1,000 hours or 750 hours that you have to put in to be active? Is that right?
Yeah, and so that's a whole other topic we could do another day, is passive versus active real estate investors. But yeah, kind of similar to what I talked about with business owners. It's when you're claiming losses is when the IRS kind of goes, what's going on here? Why would you be incurring losses year after year with no plan of profit in the future? So yeah, real estate, if you're claiming losses, I find that those can get audited more frequently. And if you're not reporting it correctly as a passive investment where the losses get suspended year after year, that could be another area that you could get scrutinized by the IRS.
Yeah. I guess, how long until you're off the IRS's radar? Like, let's kind of, like, in summary, like, how long do you have till you're like, hey, I don't have to stress about this anymore?
Yeah. So the big threshold is the 3-year statute of limitations, right? I talk with clients about this all the time. If they had some transaction that they maybe was questionable in the past, or something they didn't know how to treat, or weren't confident in the tax reporting, 3 years is generally the threshold to where the IRS can't go back to 2013, for example, and say, hey, you didn't report your charitable contributions correctly. The big caveat there is that if it's over 25% of your tax liability, so let's say you had a big gain one year, you sold your business, or something very substantial on your return where it equaled over 25% of your tax liability, the look back increases to 6 years. And so, that could go back to 2016, for example, or 2017. And then the other one is if there's fraud, there's no statute of limitations, right?
Yeah,
So
I was just going to mention that, is that if you're intentionally doing something mischievous or deceptive or lying, essentially, then there's no real.
They could go back to 1995 if they wanted to.
Yeah.
And then another thing I tell clients all the time, I just had a client sold a rental property that he held for like 35 years, right? And he was going, well, I know I put, 100,000 or so into it, but I have no I have no receipts. I have nothing to show for it, right?
Yeah.
Anytime you have basis tracking that you're selling in the current year, that's a 2022 transaction. That's not a statute of limitations thing where you can't say, well, over 3 years ago I put 100,000 into it. You can't look into that. No, it's a 2022 transaction. They can go back 35 years of asking for all your receipts and substantiating that number that you reported in 2022.
Yeah, that would be hard. That would be hard to do. So I think the best practices is make sure that you document, make sure that you're keeping copies of receipts and stuff like that. Maybe digitize some of this data so that it just lives in a file, and just in case if you ever need it, you have access to it. I think.
Yep, I've got a file right over my shoulder right here. Right.
Yeah.
I can't do it there. Right there. That I throw all my receipts, anything associated with my house, I throw all the receipts in there, and I try and scan them in periodically. So
yeah, there you go.
Just keep a file, and make sure you keep records of anything that you're going to be reporting in the future, especially anything associated with your cost basis.
Yeah. So I think that's the biggest takeaway should be, is make sure that you document your stuff. So
absolutely.
If you have any questions,
music to my ears. Music to my ears when I hear people documenting all their stuff.
Yeah, music to your ears. Yeah, and don't lie. Obviously, that should be kind of like
yes.
given.
Don't lie, everybody.
Yeah. So if you have any questions, comments, please put it below. Please like this video. It helps other people find this type of content. And thank you for watching.
Thanks, guys.
All right. See you, Kyle.